ever replace banking, so don't worry. Okay. In a commercial transaction, once a buyer is buying from a supplier, there's a commercial trading transaction going on. And basically, there's two dimensions, the price and the payment terms. Definitely the product, the quality of the product, the specification of the product. But at the end of the day, the big fight is on the price and the payment terms. And here comes a conflicting, or what I call a zero-sum game, where the buyer wants to push away to the maximum the payment terms, while the supplier, his counterpart, is trying to push the reverse way to cash in the earliest possible. So supply chain finance solve this dilemma, solve this conflicting trading transaction. So it ensures to the buyer that his payment terms will be deferred, will be extended, while giving the option to the supplier to cash in the earliest possible. So through a true sale transaction, and true sale means that there's an approved invoice and there's a legal framework around it. The invoice is becomes kind of a collateral. It becomes kind of an asset. So it's a payment obligation from the buyer committing to pay at maturity date, at the new maturity date, at the extended maturity date, the net face value of the invoice. So then comes in the banks, the FIs, okay, to fund the transaction, leveraging the credit rating of the anchor buyer. So usually a supply chain finance is a buyers-led program, and that buyer is a large corporation with a good credit rating. And the 70% of the suppliers are SMEs. And I mean, this is a benchmark. It's a global, worldwide benchmark that 70% are SMEs and 30% are companies that are either domestic or international, but that are larger in size compared to the buyer. So on the SME side, those suppliers are going to benefit from the rate arbitrage between the yield being applicable on the buyer versus what they can aim for. So in that transaction, a supplier is going through a totally off-balance sheet transaction. So the supplier is not being lended, okay? He's not contracting a loan. He's not using his balance sheet, okay? It's the buyer, okay, who's leveraging his power, okay? So the real benefits is that the supplier that used to deal with that specific buyer at, let's say, 90 days, today on paper, the 90 days becomes 120 days, but the suppliers can cash in at day 5. Okay. So just the few days that are needed for the buyer to stamp, to accept, to endorse the invoice, and immediately the supplier is being paid. So from the supplier side, it's a beautiful transaction. They're getting their cash at day 2, day 3, day 4, day 5, whatever. It's totally off balance sheet, and it's at a very good rate because it's the rate of the anchor buyer. The buyer has benefited from a free of charge extended payment terms. So the buyer is getting 30 days extra or 45 days extra at zero cost. Why? Because the supplier has bared the cost of the discount rate of the invoice. So usually when you contract a loan, at the end of the day, you have to return the loan and the cost of the loan. Yeah. In that case, the cost of the loan went on the side of the supplier. So from the buyer's side, it's all about working capital optimization. So by extending the payment terms, they're freeing cash trapped into their balance sheet. They're boosting their cash flow. From a bank's perspective, so there are 3 stakeholders, the buyers, the suppliers, and the banks. The banks love it because through one anchor buyer, they're accessing thousands or hundreds of SMEs, leveraging the risk of a powerful organization, a powerful corporation, and it's kind of a free cost of acquisition for all of those SMEs. Supply chain finance has also some, let's say, macro level dimensions. Whereas today, the highest failure rate of bankrupt SMEs is, on a global scale, is about delayed payments. So the number one reason why SMEs fails in the world is because they get paid late. And the big boys, the big powers of the world, they benefit from the weakness of the SME to delay payments. So by having this factored into the ecosystem, in a way you're protecting the SMEs and you're contributing to the cash conversion cycle into the economy, contributing to the GDP. So if we take example of what happened in UK, when Prime Minister David Cameron launched the supply chain finance as a government, as a British government, it affected 110,000 British SMEs. Not only he ringed the fence around them and he protected them, but 3 years later, 18% of those SMEs were offering new jobs. So it's not only about direct GDP impact, but it's also on the long-term employment and global improvement.
Sure.